5-minute lesson on average versus actual rates of return. The vast majority of Americans today are using 401ks or IRAs to save money for their future retirement. The most common underlying investments for those plans are mutual funds, which purchase shares of company stocks from the stock market. Understanding how the rates of return from the stock market or mutual funds are applied to your retirement account is extremely important. Most rates of return for the mutual funds in these retirement accounts are expressed as an average percentage over a given time period. An average rate of return can be very different than the actual rate of return. To illustrate the difference, let's assume you have $100,000 in your retirement account, and during the next year you earn 100% return. You would now have $200,000 in your account. If during the following year you incurred a loss of 50%, your account value would drop back to the original $100,000, giving you an average rate of return of 25%. The 25% average rate of return is calculated by subtracting the 50% loss from the 100% gain, and then dividing the resulting number by the 2 years. But if you started with $100,000 and 2 years later you still only have $100,000, your actual return or effective yield is 0. Even though the math gave you a 25% average rate of return, your account did not experience any growth. This is an exaggerated illustration to help you understand this important concept and how it applies to a lump sum of money in a retirement account. But most people don't start out with a large lump sum of money in their retirement plan. So let's look at someone who started saving for their retirement 20 years ago. Let's assume they put $5,000 a year into their account at the beginning of each year and continued doing that for a total of 20 years. Looking back over the last 20 years from 1993 through the end of 2012, the S&P 500 stock index has averaged an incredible 9.92% average rate of return. During that 20-year time period, the S&P 500 stock index experienced 16 positive growth years and only 4 negative or losing years. Traditional financial planning calculations typically use average rates of return to project values into the future. So let's do the math and see how much money we should have in our retirement account at the end of those 20 years. $5,000 per year, growing at 9.92% interest for 20 years, would create an account balance of $283,786. But as you saw in our previous example, average isn't the same as actual. The actual yield during that 20-year period was really the much lower number of 6.6%. This much lower rate of return was created by something called market volatility, the positive or negative movement of the market each year being applied to the account balance. So even though there were only 4 years out of the 20 that the market lost money, those negative years had a very significant impact on the actual rate of return. By applying the actual yield of 6.6% per year for our $5,000 per year contribution instead of the 9.92% for 20 years, our actual account balance would only be $196,243. An astonishing difference of $87,543, or 30% less money than what you would have expected. Something else that can have a significant impact on how much money you end up with in your retirement account are the fees that are assessed by the mutual fund managers to manage the mutual funds in your 401k or IRA. It is not uncommon for the combined fees associated with the management of your retirement account, particularly 401ks, to exceed 2%. If we apply this 2% fee to our account balance each year for 20 years, our effective yield drops from 6.6% to 3.63%. And instead of $196,243 in our account, we end up with only $143,251. Using traditional financial planning math calculations, we would have expected to have $283,786 in our retirement account at the end of 20 years. Instead, after factoring in market volatility and management fees, we're left with a retirement account that has only $143,251, less than half of our original projection. And to add insult to injury, we haven't even talked about the taxes you still have to pay on the retirement account. There is a better way, a much better way to build wealth and create a more certain financial future. If you'd like to learn more about how you can avoid the financial devastation of market volatility, high management fees, and at the same time create a tax-free retirement plan, contact the person that referred you to this video.